you say it's lower risk, yes. High risk, high reward.
Yeah. Welcome back. If you do not want to see other people get rich and you being left behind, this Venture Capital Masterclass is definitely for you. So whether you're seeking investments, maybe you want to work in venture capital or be a brilliant investor, hang in there because now we're starting to get somewhere. And today we're going to talk about two key giants in the investment world, which is venture capital versus private equity. This is going to be so interesting. And if you're into venture capital or investment, this episode is definitely for you. So stick around because this will be very useful for you. Kat, are you ready?
Hello.
Our business lawyer. Let's start.
So venture capital, this is a master class about venture capital.
Yeah.
So we talked about it quite a lot.
Yeah.
We talked about early stage startup investments, a fund with a lifespan of 5, 6, up to 10 years, typically. Investing early in high risk startups, taking typically a minority stake, like 20-25% of a company, investing into the company. Typically being very focused on the founders, the core team, believing in them and providing support along the way and seeking, of course, high yield return and high yield exit with quite a short time frame, I would say, within the fund lifespan. Right?
Yep, I'm with you.
So high risk, high reward.
Yeah.
Then we have the private equity players, which actually have many similarities to the VC. They're also a fund with a limited lifespan. They also have limited partners, investors, and the GP, the fund manager, who manages the fund and makes the fund decisions. And they typically have the same waterfall with a carried interest for the manager, the GP, 20%, that comes after the LPs, the investors, get return on their investment. So far, very similar. But the private equity typically focuses on more mature businesses. Typically, so you say it's lower risk, yes, but if it's leverage finance, it can be higher risk also due to that. But typically higher ticket sizes, bigger amounts, and typically they take either all of the company, buy it out, or they at least take a majority stake. And they will most likely want to change the management. So they are not that keen on who's the founder of this big company. Instead, they want to change and put in their own SWAT team, their own management. And they also look for an exit within the fund lifespan.
Okay.
So some similarities and some differences.
Okay. And keep yourself educated. Like, subscribe, and share our channel because this is so good knowledge for you. Let's keep on going.
Yeah, we can summarize it for you so you get a spreadsheet of it. Key differences between venture capital and private equity. Number 1, stage of investment. Venture capital, early stage or high growth startups. For private equity, it will be mature, established businesses. What about the risk level? High risk startups may fail. That's venture capital for you. In private equity, it will be lower risk because the companies already have operations. They're more mature, but remember, it can be leverage finance. And the investment size in venture capital will be smaller investments from thousands to millions of dollars. In private equity, it will be larger investments, hundreds of millions of dollars. It can even mean that they buy out a company from the stock market. And the transaction type in venture capital will be investing into the startup. In private equity, it will be a secondary transfer where they buy the shares from another shareholder. And equity stake will typically in venture capital be a minority ownership. And in private equity, it will be a majority ownership. And the involvement In venture capital, it will be strategic advice, mentorship, and networking. In private equity, it will be restructuring, cost cutting, and an active management. And as regards the founders, they will be relevant in venture capital, but not relevant in private equity, since they typically want to set in their own management. And last but not least, the exit strategy. Well, it will be quite similar in both cases, I would say. Venture capital typically wanting an IPO or acquisition, and private equity typically also wanting an IPO or selling it, an acquisition.
So they have some similarities, but also some other things. Yeah.
So for you looking to break into either venture capitalism or private equity, it's good to understand that there are some fundamental similarities. So for you wanting to break into venture capital or private equity, know the differences and the similarities and see what are your key strengths. And if you're a business owner, are you looking to sell your company as a whole, and is it a bigger, more mature company, then you go to private equity. If you're a startup or a scale-up, then you seek VC money, and if you want to stay on and keep working on it.
Thank you. Now we've presented two different ways to fund your business.
Yeah, quick and sweet.
Quick and sweet, and you make it easier for you to choose the right thing for you. Keep educating yourself, and you do that by sharing our channel, like, subscribe, and also share about your business. And we're also featured by the LE Fitness today. And remember, this is not legal advice. As always, it's knowledge sharing, which we are sharing with you for you to gain more insight in this time, VC world.
Yeah, thank you.
That's it for today, and until next time, hej då.
Hej då.